I'm going to give you an easy to understand explanation of the investment strategy that Warren Buffett swears by, and that is index funds. It's a simple way of investing, and after this video, you'll understand what exactly index funds are, as well as I'll give you the top 3 performing index funds, and I'll show you my first trade. What exactly are index funds? Well, they're just a whole bunch of stocks all put together in one to mimic the overall stock market. Why is this important? Well, because the overall stock market has given annual returns of nearly 10% over the last 30 years. But some individual stocks haven't had those returns. What if you picked the wrong individual stock? What if you picked Netflix or Etsy or Zoom or Bed Bath & Beyond? All of those stocks have gone down by at least 50% since 2021. But the S&P 500 gained almost 27% in the year of 2021, and it's gained annually since 2021, 13%. You're better off to invest in an index fund, a basket of stocks, instead of investing in one individual stock. When you invest in an index fund, it means that you are investing more in alignment with the overall market, which again has gained and has increased annually almost 10% over the last 30 years. With an index fund, you can have a piece of Apple, Microsoft, Google, Amazon, and other strong companies in the S&P 500 all in one fund. What exactly are you doing here? You are spreading your risk. You're not just buying one stock, you're buying a basket of stocks. And don't take my word for it. The billionaire Warren Buffett, and arguably one of the best investors in the world, he swears by index funds. In fact, in establishing a trust for his wife's estate, he has directed that 90% of his assets go toward, an S&P 500 index fund. 90% of the assets to an index fund. Warren Buffett is doing that. And, and you're probably like, well, Skye, what about day trading? Day traders, that's fine, but there's only a 10% success rate. And you may say, well, what about options trading, being an options buyer? Option traders have even less, only a 5% success rate. Oh, well, what about individual stockholders? Well, listen, of all of the people who invest in the US stock market, only 14% of them invest in individual stocks. So what does that tell you? The money and the success is going toward passive ways of earning, which is through things like an index fund. But the success rate of index funds, as we know, it tracks the overall market, which has had almost a 10% gain, a 10% return over the last 30 years. And it's not just over the last 30 years, it's actually over the last 90 years. Why pick one stock when you can just track the overall market? You can buy a basket of goods. When you are picking individual stocks, you are actively managing those stocks. You're always looking at your phone. You're always looking at the market. You're doing all of this research. You're doing all of this active work. No. Index funds are passive. They're a passive form of investing. And you may be saying, but the S&P 500 is boring. I'm putting my money into an index fund that tracks the S&P 500. I don't have the thrill and the excitement of the highs and the lows and the ups and the downs of the market. And you might be saying, but I can pick the best stocks. I'm so good at picking the right things. All I have to do is pick companies that are winners, pick strong companies, and I'm real good at stuff like that. Well, you know what? Let me just give you the facts. Every year, the S&P 500 and the Dow Jones, they do a study on active versus passive management. And you know what they found? They found last year that after 10 years, 85% of large cap funds underperformed the S&P 500. And after 15 years, 92% of those funds underperformed the S&P 500. And even Warren Buffett himself, who is considered to be one of the greatest stock pickers, one of the greatest investors, he's not making the same returns on his individual stocks that he used to because the market has changed. It's not as simple as just picking stocks. Maybe 10, 20, 30 years ago, you used to be able to just pick stocks and do well. You cannot do that anymore in this market. Warren Buffett can't even do that. To put it to you like this, over the last 15 years, ending in 2019, Berkshire Hathaway, Warren Buffett's firm, got a return of about 9.4% annually. And you know what? That only slightly overperformed Vanguard's total stock market fund, which returned 9.1%. Work hard to get 9.4, or be on something that's more autopilot to get 9.1. 9.4, I'm spending all my time, I'm wasting all of this time, I'm not spending as much time with my children, I'm not spending as much time on my business, I'm not spending as much time going to the spa and going on vacations, I'm spending a lot of time doing research and I'm getting 9.4, or an index fund that tracks the market and get 9.1. It's so close, you might as well not even waste your time doing all of that stuff over there. The stock market is not the same as it was in the 80s and the 90s, so when you hear stories of uncles or aunts or mothers and fathers, right, who invested in those times and they made a fortune picking individual stocks, it's not the same. Because Warren Buffett, 1985 through 2004, his returns surpassed the S&P 500 by like 10%. He was making 20-something% returns. But it's not happening anymore. He was going from making 20% returns plus to now 9.4, which is slightly above the Vanguard total stock fund. All of those 20% really high returns from picking stocks, they're not happening anymore, not for even Warren Buffett. You know, yes, years ago, people figured out that if you shifted a portfolio over this way or shifted it over that way toward this fund, that you could outperform the S&P 500. But now, everyone has so much knowledge and has caught up with things that there is not that competitive edge as much. So everyone starts piling into all of these strategies, all of these different portfolio styles, and therefore you're not able to have as much gains for each and every person. So you're not really outperforming anymore. You have institutions buying stocks. You have all of this institutional money. So the competition is tough. It is fierce, which is making it harder to outperform the S&P 500. And you don't have to. You can just get an index fund that tracks it. 500 companies represent 85% of the entire U.S. stock market. And you know what those 500 companies are? They're called the S&P 500. So get an index fund that mimics the S&P 500 instead of buying individual stocks. What does this mean? It means that you can put your investments on autopilot because the S&P 500 has a flawless track record of performing over 30 years, 10% annually on gains. You can invest without worrying about stock market fluctuations. You're keeping your money in that fund for the long term. You can simply budget out a certain amount to go into that index fund on a regular schedule. And you keep it in there for the long term. You're not pulling it out after a year or after 2 years. You're keeping it in there because index funds are meant to be a tool to use as a long-term passive investment. Can you take it out? Yes, but you don't want to because you want to get the benefit of the long-term gain. So what are the top 3 index funds? Vanguard S&P 500, iShares Core S&P 500, and SPDR S&P 500. Let's just say you invest $10,000 in 2017. By the end of 2021, that $10,000 based on the S&P 500's rate of return would have grown to become $23,340. $10,000 grows to $23,000. 2017, 2021. Based on the S&P 500's rate of return. And based on the tables here, you can see that even with the worst performing index fund, the $10,000 would have grown to $23,230 over that same 5-year period. And based on the chart, those returns are pretty high because it included the year of the pandemic 2020. So we'll keep in our minds that 10% annual increase based on the 30-year track record of the S&P 500's returns. Now, as you're picking your index funds that work best for you, be sure to stay away from leveraged ETFs or index funds. Those are the ones that promise to give 2 times and 3 times the return of the S&P 500. It's not about getting 2 times and 3 times the amount of the S&P 500. No, it's about building wealth the safest way over time where you're tracking the S&P 500. Investing in S&P 500 index funds is one of the safest ways to build wealth over the long term. But those leverage funds are not a safe way of investing and they don't belong in a long-term portfolio. You're like, well, if index funds are so great, why don't I ever hear people talking about them? It's simply because they are simple. They are more boring. You can put them on autopilot. You don't get the thrills of the highs and the lows and the ups and the downs and all of the crazy fluctuations. That's why no one is talking about it. Not a lot of people talk about them. Another reason is, in life, pay less attention to what people are talking about and more attention to what they're actually doing. Only 14% of people are investing in individual stocks. So the rest of the people that are investing in the US stock market are doing it in a more passive way through things like index funds. So now that you know about index funds, here's a snippet of me going through the actual buying process. Now, if you got value out of this video, go ahead and subscribe for more content like this, and thank you for watching, and I will see you in another video.